It's the spring of 2000, US stock valuations are through the roof, and Vanguard founder Jack Bogle does something very unexpected. He slashes his stock holdings down to just 30% of his portfolio. Shortly after, the dot-com bubble bursts, and Bogle's bold call is vindicated. Today, Vanguard's brightest have a startling prediction of their own, that the 30-70 portfolio will outperform over the next 10 years. So is history about to repeat itself, or are these guys talking crazy? Let's hear them out. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise. And I'll admit, my head turned when I saw Vanguard's 30-70 portfolio suggestion. It seemingly flies in the face of conventional investing wisdom that stocks tend to outperform bonds over the long term. But of course, that's not always the case. So I'm approaching this with an open mind, and I hope you will too. Let's find out more about the rationale behind this bold forecast. Joining us is Surenanthan Tharumakulasingam, head of national accounts and institutional at Vanguard. It's a pleasure to have you in studio with us as always, and we like having you back on the show. Surenanthan, I'm curious what the client reaction was when they first heard about this bold call, 30-70.
Yeah, I think that's a good place to start. I would say there's probably 2 reactions, right? So the people who know Vanguard's research and have followed us for years, not entirely surprised. And I think when we tell more advisors and end clients, I do think there's a little bit of a sticker shock there. I think initially the thought is, oh, that doesn't seem right. And a lot of it, as I think about it myself, it's the experience that they had with bonds in 2022, right? And so it's become a little bit of an ugly word, right? And I was telling my colleague Al earlier, I had the privilege of taking my son to Disney World last year, and he didn't know what a roller coaster was. I told him it's going to be great, it's going to be nice and easy. He got on the roller coaster, had a horrible experience. So if I say the word roller coaster now, he just has these memories of histories. And I think it's similar to when it comes to bonds. And so when we say, hey, 30% equity, 7% fixed income in bonds, at first people are a little bit cautious, they're a little bit concerned, and then we get through some of the rationale, which I'm sure we'll get to today, and we get into a good conversation at the bare minimum.
Yeah, I think a lot of investors, over the years have become very comfortable with taking on a lot of risk.
Yeah.
But, what goes up must come down eventually,
exactly,
right?
Yeah.
So I know that's part of the rationale. We'll get into that in more detail. But tell us a little bit more about this forecast. Like, where did this come from? Is this like, Vanguard's ivory tower, or like where does it come from?
That's a great question. And a lot of my job is to kind of walk through what we do at Vanguard all the time. And so this report or the research that we've done, it's not unique to this year, right? So every year we do something called our Vanguard Economic Market Outlook. It really just takes our best minds across the globe, trying to put in economic indicators that we think are good to help predict what's going to happen in the future. So we have something internally, we have a lot of acronyms, something called VCMM, which is our Vanguard Capital Markets Model. It's taking things like inflation, it's taking things like where the yield curve is today, expected earnings, and we put our inputs in, and then we kind of run this Monte Carlo simulation. In other words, we try things out 10,000 times. What are the outcomes that we could likely see? And then we try to say, what's the best portfolio based off these outcomes? And ultimately, we do that on a yearly basis. And this year, when we look at it from let's not tie ourselves to the 60-40, what is the right asset allocation going forward over the next 10 years, 30-70 comes out on top.
So, take me through some of the context behind this thing, because this isn't like a blanket, one size fits all. So, what are some of the key assumptions here, parameters that people need to think about?
And that's right. It's not a one size fits all. And at Vanguard, we truly believe that you got to think about your own investment goals and your objectives that you want to get through. That being said, this model, let's talk about what the model is built to do. It's looking at over the next 10 years, right? So this isn't an infinite time horizon. Your time horizon might not be 10 years. Mine might not be. My son's most definitely isn't the next 10 years. And so we're looking at a point in time. And what we're trying to look at is what the best interplay between equities and fixed income is. So we're taking a bunch of things into consideration. So the first thing is this going to be realistic for you in your time frame? But it's all economic data that we're using to power this engine. So what does that mean? It means we're not taking into consideration trading costs. We're not taking into consideration your potential risk aversion or how much risk you want to take into in your portfolio. So it's not a one size fits all. It's our best thinking based off where the market is today.
Is there I guess, like an investor archetype in mind? Like, is this for like a retiree or a near retiree who would most likely take this to heart? Is this for someone who's like a young investor who's got like 20, 30, 40 years? Like, do they just look through this completely? Like, who's this in mind for?
If I were to pick someone I think that it could make sense for, it's either someone who has an investment horizon or has something coming up in the next 10 years, and they don't want to take on a lot of risk. Like you said, the equity markets have done really well over the last couple of years, but you don't want to be holding on to equities should something actually pan out that's negatively impacting your goals that you have. So it's that type of investor where they're worried about something over the next 10 years, or it's the type of investor that doesn't want to keep up with the market on an ongoing basis. And when they do pay attention, they get worried and they almost feel like they need to make a change or a trade. This takes away some of that risk that we think, and it's more of a mellow over the next 10 years.
Yeah, I mean, we're emotional creatures, so that's obviously a big part of this. So thank you for the important context. We're going to dig into the details beyond the headline.
Yeah.
And you'll notice you have an empty chair beside you. This is not like a gotcha daytime talk show or something like that. Don't worry, you are not the father.
Yeah.
We're going to have a special guest joining us later this hour, so everybody stay tuned for that. Going to have a lot of fun. Anyway, we're going to get into this, what is inside the 30/70 portfolio and what people need to be considering when they dig into something like this. For those in the audience, if you want to get in on the conversation, we'd love to have you. Make sure you submit your questions to us. If you're watching on Webbroker, you can use the chat box to send your questions to us. If you're watching on a broadcast platform, it's the questions and comments box. And if you're watching on our YouTube live stream, you can click on the link in the description. It's going to take you over to our broadcast platform, and that's where you can ask your question. Okay, so Surenanthan, give us a sense of the rationale behind this 30/70. Why does Vanguard think that this is going to be what's appropriate for the next 10 years?
Yeah, no, that's a good question. So if you look at the 30/70 or any balanced portfolio that's equities and fixed income, there's two sides of that, right? And so I think we have a case for both sides of it. On the equity side, to your point, the market has done really well over the last couple of years. And if you look at it from a fundamental perspective, it seems a little stretched. So what do I mean? I mean, going forward, are we as likely to have the returns that we had over the last 10 years? Probably unlikely, because it's going to require a lot of earnings growth for stocks and companies. And so they need to deliver more on their promises going forward. On the fixed income side, we're actually starting at a pretty good place. What I mean by that is yields and coupons, what your debt is giving paid to you, it's higher than it has been in the past. So you have this ability to collect steady income on fixed income for the first time in a very long time. And you don't have to take on the same risk that you'd get on the equity side. So it's really a marriage of both of those two components. And then from a risk averse, so if I don't want to take on more risk, what is better off for me? There is a chance that fixed income may meet your needs and your end objectives without taking all that equity risk that we have in the market.
Yeah, and to that point, and we were just showing a table up on screen showing that the performance difference is a little bit higher, or expected performance, for the 30/70 versus the benchmark 60/40. But the interesting part was that the volatility much lower. And in particular, again, if it's somebody who's like a near retiree, somebody like that with a shorter time frame, the expected maximum drawdown, just a third of what the benchmark would be.
Yeah.
So it's that what you get for the amount of risk you take is really the key here.
Yeah, that's where we're starting off right now, and we're in a place where yields are in a good spot. Where do you need to take on more risk, right? And whether the return is going to be better in this portfolio or the other one, that's time will tell. But at least we know the road to the 10 years is going to be less bumpy with more fixed income in your portfolio, especially at starting high yields. And I think that's an important part, because where you're starting with yields matter in terms of the performance of a bond. Yield to maturity is a metric that is a very good predictor of what the return for bonds are. And the yields that we're seeing today are at a much better rate than they were in 2022, 2021, where people had a little bit of a rougher experience with fixed income, where interest rates start to go up so much, right? We think we're in a better place now than we were then.
Okay, so all those factors coming together, and of course the tariff war overhang, all of this too, which adds volatility to the market. So could potentially again kind of smooth the ride out with the 30/70. That said, when we look at the longer term history, there haven't been that many times in history when U.S. bonds have outperformed U.S. stocks. It's happened about 17% of the time over 10-year samples. I looked up this data, and typically when that has happened in the past, there's been some terrible market calamity. I'm thinking dot-com bubble bursts, Great Depression, Great Recession. That happens, and that's why. Is Vanguard telling us that there's like some really scary event coming like right around the corner that we need to be cowering in our bunkers for, or something like that?
Yeah, that's a good question. I tell you, if I knew with certainty. I probably wouldn't be here talking to you. I'd be on a beach somewhere, right? And so it's unlikely. But what we're saying is it's more likely that the market isn't going to continue at the pace it's going to continue today. So does that mean it's going to be a market crash? Maybe, maybe not. We don't think there is a market crash that's imminent by any means. We just think we're in a place right now where it's time to start thinking about de-risking a little bit, right? What the market is pricing in on the equity side is some steady growth and growth at rates that would have to double what we've seen in the past. And so we bought clothes, and the analogy I use is, my son's 3.5. I bought a lot of clothes for him when he's 5, 6 years old. We're hoping he grows into that. There's a chance he may not, and I spent a lot of money that's gone to waste, and that's what the equity market's doing as well. It's pricing in future growth, and do we think it's going to happen perfectly? History has shown it's very hard to meet these levels that we expect from the market. And so that's part of the caution here, where equities are expected to grow at a clip that is very unsustainable. So is it a full market crash? Probably not. But is there a chance that it's not going to get to where the market thinks it is? We think that's more likely not happening in the future.
Yeah, and I'm reminded of that phrase that the stock market can remain irrational longer than you can remain solvent. Mm-hmm. And I think for a lot of folks sitting on the sidelines, they probably are feeling that way.
Yeah.
But what goes up must come down. I come back to that phrase as well, too, because valuation does matter at some point.
Exactly.
We just don't know exactly when that point will be. We've talked about 3070. Let's take a look inside this thing. We have a chart that breaks down the composition of it. Just talk us through some of the highlights. So what should somebody take away from this?
So I think obviously you see the big shift from 60/40 to 30/70. When we're looking at the equity side, so let's break it down into two parts here, right? When we're looking at the equity side, we're seeing the U.S. market still a leader here. So this isn't get away from the U.S. market. We think there's opportunities within that U.S. market that historically they didn't drive the returns that we'd hoped it had, right? And so a big call out is U.S. value. So where have we seen the growth over the last 5-10 years? It's been growth companies. It's been these large tech firms that are very concentrated at the top of the S&P 500. They've really helped us drive forward momentum. Why have they driven some of that forward momentum? It's what they're doing in the AI space. And so a lot of people get excited about AI and they think, hey, this is going to continue to propel these growth companies, which it may, but there's also a likelihood where that competition is going to get more and more fierce. Mm-hmm. And so now who wins in that situation? So there's a likelihood where large cap growth can take a blowback from wherever AI lands. But that technology that they're producing, it's going to help a lot of smaller companies. It's going to help companies that are being overlooked today. And value is a sweet spot where there's a lot of firms that are looking to use AI to minimize their costs, right? And continue to give you that same growth revenue that they had in the past. So that's where we think value has an opportunity. And that same logic applies to something like small cap stocks, right? Where they're resource intensive. And if we can automate some of that resource away with AI, there's an opportunity for them to continue to grow. So it's the second effect of the benefits of AI. It's not that pure AI growth, it's just what they can do to help with companies that are on that value and small cap space. And on the fixed income side, and I think this is the question I always get is like, well, you're saying we should be cautious of U.S. equities, but you're saying let's buy some U.S. fixed income. And right. I think the difference is expectation, right? And the ability to deliver. The expectation for equities is really big growth, which I think is hard to deliver on. But the expectation that some of these strong companies, that you see in the top of the S&P 500, are they likely to pay their debt? I think we see that to happen in the near future, right? And so fixed income is a little bit safer in that regard.
And does the same apply to the U.S. government? Because there's been a lot of concerns about, maybe not the U.S. defaulting on its debt per se, but the rising debt burden and stuff like that. Is the logic still that it's going to be status quo, like there's not going to be a change in terms of their creditworthiness?
We've seen nothing, I think, that to tell us to move away from the U.S. government in a total shift, right? I think we believe the ability to repay loans and debt is still there, and so we're not overly concerned about that. And then when you marry what this model is looking at, right, the likelihood of something to happen versus the return, that likelihood we think is lower than the likelihood of stocks continuing to grow at their pace.
So I'll tell you one thing that really jumped out to me about that was that U.S. growth stocks, these have been the engine of this bull market, one of the best in history over the last 10, 15 years, to say. It's only 5% of the total portfolio, which seems minuscule. Yes, I know we're talking about that valuations are stretched and stuff like that, but I remember, and I think it's almost 2 years to the day almost, you were on our show talking about it's value's time to rise after this big underperformance, and yet here we are still kind of waiting. So is it AI that's the drive, the magic that makes this reversal happen? Like why now, I guess?
Yeah, in that 2-year time, I will say maybe that first 7 months, I felt really good about that. Like, I think value did quite well, and it's going back to the fundamentals. We thought there was an opportunity for, can companies continue to grow? Now, we've tapped into AI quite aggressively over the last year and a half, and that's allowed more optimism in the market, right? At the end of the day, the equity market's a balance between pessimism and optimism, and I think AI has driven more optimism in that sense. The unfortunate thing from a valuation perspective, that just means it's more stretched today than it was 2 years ago. And we are seeing value companies or companies who are able to use and cultivate some of these resources in an appropriate way continue to deliver. It's just the FOMO that comes with growth has kind of overridden the market overall.
Okay.
Right?
That makes sense. Yeah, I didn't mean to put you on the spot there, but it's been a conversation like we keep hearing about.
For sure.
Value's got to come back. Small caps got to come back at some point. So it's interesting to hear the rationale behind that. Obviously, this forecast that Vanguard has hinges a lot on those U.S. growth stocks, those big boys being overvalued to some extent. There's a lot of debate, though, and it depends on what metric you use to determine, are these things actually overvalued? Like, is there actually a warning sign here? Like, and we have a chart that shows this. If we look at CAPE, a cyclically adjusted price to earnings, it looks like it's near the .com highs, and okay, that looks scary. But if we look at it on a trailing 12-month price to earnings, we have another chart that shows that. It's high, but it's not like crazy, go hide under my blankets kind of like fear. So I'm just curious, like, what metrics is Vanguard specifically looking at that have you leaning towards the overvaluation?
Well, I think CAPE is a big part of it, right? Okay. So if you're looking at CAPE and look at the inputs to something like the cyclically adjusted price to earnings, it's looking at inflation, it's looking at interest rates, but a big part of what it's looking at is expected earnings. And I think that's the difference between what we're looking at, the trailing 12-month price to earnings, and then the CAPE going forward is the expected earnings, the market and then the industry overall can think it's going to grow a certain way. Well, what's continuing to push valuations higher and higher is there is a strong contingent that believes that expected earnings isn't really taking into consideration how much it can grow. And I think that's what happened with AI, for example, right? When we sat down 2 years ago, we didn't think there's going to be much more leeway. There's only so much earnings. But then AI tapped into something, and now the optimism around it has gone even further. And so when you look at CAPE, it's going to say, well, this seems a little stretched, right? Valuation is really high. How much more can it possibly earn? But the detractors to that metric, and anyone who sits here and is probably a great growth manager, will probably tell you, well, no, the market isn't taking into consideration all the things that AI or all the things these other technologies can do that haven't really been priced in yet. And so that's why, to some people, CAPE may not be a concerning metric, because expected earnings is a big part of how that input works out, right?
Just speaking of AI, and I am going to put you on the spot here a little bit, and maybe you don't know the answer to this, but there's been a lot of concern about AI bubble. Are we investing in an AI bubble? Does Vanguard have a view on whether we're in an AI bubble or not? Or
I don't think we have a view on AI bubble. I think we have a view on earnings bubble. Like, are we getting to a point where earnings cannot keep up to value, to essentially justify the valuations we are today, right? Now, here's the thing. This AI bubble, or if we were to compare it to the .com, that was very located to tech firms. AI is now seeping into many parts of society, right? It's all through all the different fabrics. And so I think there's a use case, and our chief economist does speak to AI being a general purpose technology. We do think there's an opportunity for AI to impact our life in a way that we haven't seen in the past, right? Like, take electricity, for example. When electricity was developed, people weren't thinking this is going to have the cinema industry for years to come, but it was required to build another industry. And so AI may do something like that. But around valuations, we're just strict to the fundamentals. Right. It does seem a little stretched because you and I cannot imagine all the potential outcomes of what AI can do for us.
Right, that's a fair point. Nobody has a crystal ball, Vanguard included, although you guys are sticking your neck out with the 3070, so it's interesting, appreciate that. One thing that also jumped out to me as well is the international stock component of things. Like, I would expect it to be higher if there's a little bit of a shift towards away from some of that U.S. growth. And I'm curious, like, why is that not the case?
Yeah, and this is a pure fundamentals thing. I think ultimately, if we took that same report that you looked at and we broke down international into its own buckets, right? Growth, value, and something else, small cap, I think we would have seen a little bit more of a lean towards international value. We think there's opportunity across the globe, right? The main opportunity is to de-risk away from U.S. growth. And I think for a lot of investors, you have to take into consideration the U.S. is such a leader that money is still going into that space. Now it's really a diversification story. So we do have an evaluation towards international equities. We do think it's potentially there, but remember, the model is looking at return and risk.
Right.
And there's an additional risk that comes into play when it comes to international, and that's currency risk that you have to take into consideration. And they may mute that in a model like this.
Mm-hmm. What about Canadian stocks? Like, where do they fit in? Because, I mean, my understanding is that this report was written from the perspective of like a U.S. investor, but we're mostly Canadian here, right? So where do Canadian stocks fit in?
And so I think there's two ways to look at this. We have a product in-house that does essentially what this report is doing, this model is doing within a Canadian product, in that we're very close to what we actually say is a good number for home bias, right? 30% is roughly the number that we have for Canadians investing in Canadian equities. And a lot of that is between the standard deviation. So the volatility. Why would you invest in Canada when it's such a small part of the globe? Well, there's some benefits around taxation. There's some benefits around just what it does to a global portfolio. It gives you access to certain sectors. So our model is saying something similar to what we've talked about in our overall research, which 30% seems to be a reasonable number there for the equity side.
Yeah, and I mean, there might be some tax benefits too, depending on what types of accounts you're using and what types of stocks. Yeah, no, that's a great point. Another thing that jumped out to me too, and we've been talking so much about the equity side of things, but obviously the fixed income, the 70 is the bigger number here. I found it interesting that the largest slice of that fixed income piece is just U.S. aggregate bonds. There's not really like a call on short, long term, anything like that. Again, like talk me through the thinking. Why? Yeah,
I think what we're trying to do is optimize for that 10-year horizon, right? And so if you go short bonds, the problem there is the duration of that bond, the ability to pay out is a smaller part of that 10-year horizon, right? And so you need to have a mix of bonds that will get you through the 10 years, because a big input into returns for bonds is the coupon that's getting paid. So if I were to front run this with just short bonds, what happens in the last 7 years of this? So that's why you need to have an aggregate bond view overall. And then from a corporate to a government situation, we think they're both well poised to pay their loans. And so there's an opportunity there from the U.S. side. We see some strong companies in the U.S. Like I said, we think the expectation of paying their debt is there. The expectation of growing, that's the tougher one in that conversation.
And then, like, again, from a Canadian perspective, if I were to have some fixed income that's Canadian, is it, again, a sort of like a big aggregate basket? Does it lean more towards the corporates or the governments?
If we were to pick, I would say we'd probably lean towards more of the corporate. And I think some of our Canadian companies are really strong, right? We're sitting in a TD booth. There's obviously some strong banks in this country that have the ability to pay back loans. And when we're looking at the credit risk spread, it's a situation where you can lean towards more corporations, really strong balance sheets. And so if we were to run this in our model, you'll see a little bit more on the corporate side than just the government component of this. Okay.
So it's been fantastic to have you kind of like walk through all the logic here. It's not like a shot in the dark. Like it is based on some pretty, what I would say is sound assumptions, at least, and certainly the logic at least. I will say though that one of the toughest things for people is to sit on the sidelines and watch other people taking more risk make gobs of money. I mean, like to my point earlier, like we are emotional creatures. How do you think somebody who's considering 30-70 would want to, I guess, level set their expectations about like how this next 10 years might play out for them, just so that they maybe can temper some of that FOMO that they might be feeling?
That's right. I think there's some human behavior that's necessary. But, I think one that we see with our advisors and investors is loss aversion is probably a bigger motivator. And so, you may sit here and 10 years go by where you haven't gotten as much of a return as a 60-40 or a more equity portfolio. The question you have to ask yourself is, are you more upset about that than would you have been if you lost money in the market? So this is more of a capital preservation or minimizing volatility approach, not an outperform. And I think we're pretty confident in saying, we're not saying this is going to be the best performing over the next 10 years, but from a risk-adjusted perspective, we think it's going to leave you with less heartache. It's going to be a lot like my son. We're not going up that roller coaster as much anymore, right? And so he gets to enjoy a smoother ride, hopefully, in the next 10 years.
Yeah, and certainly for someone with a 10-year horizon, that risk preservation piece is probably a little bit more at the forefront of their mind than just like, give me the best raw returns.
Exactly. Kind of and here's what I would say, right? Like again, you consult your financial advisor. But if you're in a situation where you're more concerned about making money, you have to look at your own risk tolerance, right? So if this is someone who has a lot more risk and is willing to make more money, then maybe this portfolio or this model doesn't really be in line with their objectives and goals. And so FOMO, unfortunately, is not the best reason to do any type of investing. So you got to think about what your outcome is. And if your outcome is pure returns, That's not what we're optimizing for here.
What do you think about the idea of somebody essentially trying to time the market with this portfolio? They say, like, look, maybe my time horizon is longer. I'm more comfortable with the risk, but like, hey, to your point, like, I want to avert some losses if I can. I switch to a 30-70, ride it out for 8 to 10 years or whatever like that, and then switch back to whatever my asset allocation is. Good idea, crazy idea.
Yeah, I would say overall, Vanguard would say try not to time the market. And I'll give you a personal, I read this research, and it was compelling. I looked at my own portfolio and I said, is this a time for me to do so? And then I weighed everything we talked about today. I have a higher risk tolerance. My time horizon's a lot longer. It wasn't enough for me to move that way. But it did give me some ideas of what I could consider into my portfolio. And some of that is, what is this entire report trying to tell us? There's some concentration risk, right? Especially on the equity side. And so there's an opportunity to introduce some other asset classes that I think in my portfolio that maybe will weather the storm without giving up all the upside that equities would have. So it hadn't moved on a personal level, it hadn't moved my fixed income allocation higher, but I did kind of look at this from an equity perspective and say maybe it's more time for dividends instead. Maybe there's an opportunity to have more than just US growth names that I have in my portfolio.
Right. The message is basically, diversification, and we've called it
exactly
free lunch in investing, and it's kind of like just a reminder to keep that top of mind.
Yeah.
Try to de-risk maybe with. Do you go to things like alternative assets potentially?
And I think you have to look at alternatives with your own risk profile. So we would look at alternatives as a replacement for equities. So that's not a replacement for fixed income, and a lot of that is because there's not as much transparency. We just don't know how that would interplay overall. And we're looking at what fixed income's role in a portfolio is, which is to be a ballast, to provide you stable income. I don't know if I would take away from my fixed income for alternatives, but on the equity side, there's definitely an investment case, and it's in line with how equities would act in the market. So you want to have a one-for-one type of swap when you're making those type of considerations.
This has been fascinating. I have to say, I appreciate you breaking down the 30-70. The headline screams like this is nutty. But the rationale is quite sound, I think. Who knows what's going to happen in the future? But I think the forecast is based on, to your point, economic forecasts and data and stuff that we're seeing that is quite tangible. So I think it's great food for thought for people. So we appreciate you breaking that down. We have a lot more to get to.
Yep.
But before we get to that, if, like myself, you in the audience have found this pretty informative and has you thinking, then make sure you check us out on social media, because we have a lot of fantastic content that we have you sneak peeks at upcoming episodes, a ton of content designed to help build your investing knowledge. We're on YouTube, we're on Facebook, we're on Instagram, lots of great places where you can consume the show and all the great content that we do. And speaking of great content, we have a fantastic edition of the Money Talk podcast that you're going to want to check out. Let's take a sneak peek at that.
You talk about that when it comes to longevity, genetics has less to do with how long you will live versus your capacity for joy.
It is easy and common to look at someone who's thriving in longevity and say, wow, what great genes that person has. But the reality is that the research shows this, that genetics predicts about somewhere between 13 and 25% of our aging experience, which means the rest is up to us. A long life, even a long life in good physical health, doesn't mean much if you don't love your life.
Fantastic episode. Make sure you check it out. Now, our live Q&A is coming up in just a minute. So if you haven't got your questions in, get them in. But the grand reveal, who is our special guest? It's our very own Caitlin Cormier, live in the flesh. She's not in Ottawa. She's not in Halifax. She's not in any of the other globe-trotting places across Canada. She's right here in studio with us. Caitlin, welcome. It's great to have you in studio. When I heard you were coming to town, I thought, we got to make a special place for you.
I love it. I love being the special surprise guest. Like you said, where in the world is Caitlin? And here I am.
Awesome. Well, we're glad to have you here, and we're glad that you're here to help us, because we're going to talk about asset allocation in WebBroker, some of the tools that we have available. So like Surenanthan and I were talking about 30-70, maybe if this is something that you're considering, what can you do to use WebBroker and help you get a handle on what is my asset allocation today, and maybe how do I want to adjust things if I'm looking to make changes?
Yeah, absolutely. So we have the asset allocation tool right built within WebBroker. So if we take a look to get to this tool, you just simply come under Accounts, under Account Details, and click, of course, very self-explanatory, on the Asset Allocation tab. You'll see at the very top we've got a little kind of pie here that's going to show us the breakdown in the portfolio, equities versus fixed income, so you can very quickly see, but also that further diversification you talk about, US versus international versus Canadian. And then as you scroll down, you'll notice there's actually a kind of a clear indication of which securities fit into each category. If you have funds, you can see at the top here, if you've got ETFs as part of your portfolio, and they're in different, some fixed income, some stock, it will actually show up in the categories as and like you said, if we're looking to rebalance, you can very quickly see what percentage each of these investments is of your entire portfolio. So you can see where you might want to move money around in order to bring your allocation back in line.
Yeah, and I mean, to that point, obviously our goals, our financial needs and stuff like that, those are all like sort of the top line things that, we consider with asset allocation. But I mean, let's be honest, like performance is a little bit too. So if you were in the tool, is there somewhere where you could go to get a look at like what is the performance of the things that I've invested in versus like some benchmarks that I might want to be tracking? Maybe it's a 60-40 portfolio I'm tracking or whatever it may be. Is there any place you can go to just get a snapshot of that?
Yeah, absolutely. So again, in the platform under performance, so we just go into accounts, we click on performance, and of course we can see our asset allocation all throughout the platform. But performance is also very important. So we can see here, you can do both a time-weighted return or a personal rate of return, depending on which type of return you prefer see. But talking about the benchmarks, if you go under the time-weighted, you can actually overlay the performance of the S&P TSX Composite, the S&P 500, or maybe you've set an annual target for yourself and you want to see how you're kind of shaping up against that. And you can have those overlaid right on top of the performance of your portfolio. So again, just a quick, simple way to be able to see how you're doing based on either your own objectives or the market in general.
Caitlin, just out of curiosity, 30-70, would you ever consider it, or are you thinking on different timelines here?
Yeah, I was thinking about that. I don't know. At this point, based on my risk tolerance, I don't know that I'm quite there, but it's definitely some compelling points.
It's definitely some food for thought too. Again, going back to that de-risking, the diversification point of view, that's something we do need to keep top of mind. It's almost kind of like insurance. Like nobody wants to pay for insurance until they need insurance, right? So exactly. Something to keep in mind. Caitlin, you're going to stick around for our Q&A. We might have some questions coming at you, and feel free to jump in with a question to Surenanthan as well off the back of what somebody's asking, okay? So the special guest feature continues here with Caitlin Cormier. Let's get to our first question. Mike is our first question. Let's see what Mike has for us. I believe Mike wants to know about, with interest rates as low as they are, wouldn't more weight on high dividend stocks make more sense than cash instruments? Also, where do dividend stocks or preferred shares fit into the equity bond spectrum? Good questions. Surenanthan, what do you got for
That's
him?
a fair question. I would say our fixed income guys would tell you that interest rates aren't all that low. So they think there's quite a bit of opportunity when it comes from a fixed income perspective to get you reasonable coupons without the risk of a dividend type of stock. That being said, where they would fit is kind of in between, right? So if we're looking from a risk to return perspective, beauty of dividend stocks is there's the dividend that's getting paid that's going to help minimize some of the volatility that you see in the market. And so that's part of some of the takeaways that we would say for investors is if you're thinking about de-risking and you don't want to go into fixed income, dividend may be a little of a buffer to get you to a point where you have more fixed cash without as much equity volatility that you'd see in the market.
Is it as simple as saying like it's somewhere in between? So like I just lop off like a little bit from the equity side of things, my portfolio, a little bit of the fixed income, and then just like stick it in there kind of thing? Like if you were going to go
I would say you still take on a little bit of risk from the equity side. So, but it's a transition. So like to Mike's question, it's a little bit of a spectrum. I would move away from purely speculative stocks to more dividend payers, something that's more established, on towards fixed income. But going back to a one-for-one, I wouldn't take it from fixed income for equity per se, because there's more risk that you're taking on when you're doing something like that.
Mm-hmm. Okay. Rosanna's got a question for us. Let's see what's there. Is there a Vanguard ETF with a 70-30 asset mix? And I'm going to go out on a limb and say maybe they want to flip that too. So is there a 30-70?
Yeah, that's a good question. Currently, no. We do have a range of asset allocation ETFs that go in the 20s, so 100, 80, 60, 40. This is actually a question that we get a lot from clients and advisors. There's an opportunity to combine maybe a a 40% and then 20% and gets you to 30. But we don't currently have something that's just specific 30-70. And that kind of speaks to some of the research that we're doing. This is independent of product. We just think this is the best asset allocation today. We're not saying now go buy a product. It's just something to consider when you're looking at the research that's out there.
Right. And there's like a lot of other asset allocation ETFs and stuff like providers out there too. So like, I don't know, maybe somebody's got a 30-70 kicking around or a 70-30, but there's lots to consider.
Exactly.
Out there. The benefit though of those is just a low fee, all packaged in one. Why would somebody want to consider it?
It's essentially kind of putting your investment in autopilot to an extent, right? If you believe this is the risk that you want to take on, all the rebalancing will be done on your behalf, right? Instead of having to build out a portfolio yourself, monitor it, trade it, it's a one-ticket solution is kind of how we refer to it. And it allows you to just kind of putting your car on autopilot and just enjoy the highway, which maybe you don't on the 401, but try to enjoy the journey ahead of you, similar to some of these all-in-one ETFs.
Right on. Okay, let's get to our next question. What do we got on tap here? Michael has a question. What are your views on low volatility covered call ETFs as a comparable investment strategy to bonds? Oh, interesting question. Okay.
That is a good question. I think, and so this is from a personal level, there is some contradiction in covered call ETFs. Personally, for me, it's trying to figure out why I'm buying an equity stock or equity ETF that's really on the upside, and to try to sell that away for some downside protection. It depends on what you're doing it with. I see there's a lot of product out there, and really you have to ask yourself what your objectives and goals are. And if your objective is performance, then that covered call defeats some of that. And if your performance is downside protection, I think fixed income has multiple roles. Downside protection is one, income is one. So I don't know if it's the perfect swap for something like fixed income. I think it's something to consider. It's on that spectrum, just like dividend ETFs are. I would still put it towards the equity risk profile than the fixed income profile.
Caitlin, I'm curious just from your perspective, because you teach lots of master classes and these products have become very popular and there's so many out there. How do you guys talk to clients about that?
Yeah, it's interesting. The thing with options is they can be so complicated. So even just understanding a product that has covered call can be a little bit outside the box. But it does give clients an opportunity if they don't want to actually do the managing of the options themselves. It does provide them some of that, the income side of things, right? So it gives them some of that piece. So they're interesting. But like you said, certainly they are still equities at the end of the day. They may not have as much potential because of that call piece. But they certainly are still, acting as equity products. For sure.
Okay, so good perspective there to keep in mind. Let's get to our next question. SAFE, I believe, is our next question. I have a defined pension plan. Can I consider the pension amount as 30% and invest the other savings in low to medium risk investments? So it sounds like SAFE's trying to basically do sort of like a bond proxy, if you will, with his pension. Do you think that makes sense?
I don't know enough about SAFE's investment picture overall.
Oh, come on, he gave you 2 sentences. You know everything about it.
I get what he's trying to get at, right? And I think what SAFE is also trying to tackle is there seems to be a little bit more risk tolerance in his personal investing style. And so I think that's where you got to think about what your goals are, what your objectives are, how much risk are you willing to take. And if he feels that that's something that gets him the fixed income component of it, I'm sure him and his advisor can figure out how much more risk is he willing to take, but more importantly, how much more risk is he able to take? Because you have to marry those two, right? A lot of people love to take risk, but are you able to do so? You got to look at that from a holistic picture. And in my seat today, it's really hard for me to tell you if that's the right call.
I think it's always helpful to, if you're considering things like that, think about it as if you were sitting from when something just went really bad in the market.
Yeah.
Don't think about it when things are great and 'cause everybody's a genius in a bull market, right? You want to think about it. Does it make sense during the worst of times and the best of times? Let's get to our next question. Suzanne has a question. I am using a 50-50 split using VBAL and VGROW. Shout out to Vanguard there. Could I consider that to be close to a 30-70 portfolio? Is that a rough approximation, you think?
Yeah, so first of all, thanks, Suzanne. I helped launch those products, so that feels really good for me personally.
Nice humble brag,
that Suzanne was invested in those. I would say, the 50-50 is going to be a little bit more equity than the 30-70 that we're talking about today. So if I was Suzanne, the question I would ask myself is, are you comfortable with that risk that you have today? And are you looking to de-risk. And if you are looking to de-risk, I think you can make some adjustments. But otherwise, what she has in those two products and what we're talking about is a good diversification between fixed income and equities. So it seems like there's a plan in place. Now the question is that the right equity amount?
Right. And so, like in that example, or you could consider with any sort of asset allocation, ETFs really just that are different weightings. If you wanted to get to 30/70, you just need to like buy more of the lower risk one basically, and that kind of tilts you there.
Yeah, so we have a couple of products that are less equity than the two that she has in her portfolio that would get you closer to that 37. Exactly.
Okay, cool. Yeah. Good to know. Let's get to our next question. What else do we have on tap? Lots of fantastic questions coming in, by the way. Michael got another one. I don't know if Michael's got like a twofer here or if this is another Michael, but in any case, there's a lot of attention on the internet about Japan unloading U.S. bonds and the possibility of destabilizing the global economy in the short term. This is like a big existential question here. Yeah. Any comment on where long bond yields might factor into your modeling?
Yeah, so bond yields are very central to our modeling overall. So we're looking at, and so this is kind of what I was referring to, my colleagues around the globe, they all have their views. So we have someone in Japan who's looking at the situation there, trying to figure out what the yields are, how clients are, or not clients, but buyers of bonds are taking that into consideration. So it is taken into consideration. I think Michael is speaking to one particular scenario. We have 10,000 scenarios where we have to weigh out. And so it is one of 10,000. And, I would say that's maybe undercutting that potential scenario because it may affect multiple. But overall, it's being considered, and it's not enough for us to make a wild change, right? And so this is where we're not trying to capitalize on the extreme tails. We're looking at the most likely situation. And so a lot of times it doesn't sound sexy because we're not saying let's do something very provocative. We're just saying we want to balance scenarios out, and that's being captured to some extent.
I think things like that, you see them in the headlines, and it immediately becomes like top of mind for you. And you don't think about the other 9,999 like scenarios out there or whatever it may be. Caitlin, I'm curious, like any sort of like U.S. bond concerns or U.S. debt concerns, is that like a big thing you're seeing in masterclasses amongst clients?
I think there's always the noise, right? We talk about interest rates. So you talked about the crystal ball and how you'd be on a beach somewhere if we could predict, right? So we get indications about what's going to happen with interest rates and those sorts of things. But I think at the end of the day, you kind of have to have that long term. You set your plan, you have everything in place, and really try not to get caught up in the noise and caught up in all these little things that are happening. Because if we did, we'd all be day traders, or I don't know. we'd be moving a lot more than might make sense for our long-term plans. So, yeah, it could be tricky for sure.
It is very hard to fight the headline FOMO, though. I could totally empathize with people on that, especially because the media loves to push these kind of stories because it's interesting, it's provocative, right? And that's what gets clicks. I think we have time for one more question. Let's see what we have on tap. Richard has a question. Would the Fed cutting rates in the next couple of years be beneficial to the fixed income side of the 30/70?
Yeah, I think Richard's touching on one of the comments I was making where yields are now is important of what the return is going to be over the next couple of years. So going back to 2022, I think where it was bad for fixed income is yields were so low, they really only had one direction at that point, and it was up. And there's a negative relationship with yields going up and the price of bonds today. And so at that point, it was a detractor for bond performance. Where we are today, where yields are, if the Fed were to cut rates and our Bank of Canada were to continue to cut rates, there is a tailwind for bonds because, of course, the bonds today are going to be valued a little bit more than the bonds being issued in the future. So in that scenario, you get that advantage of having a cutting cycle. But the other part of where we are is, should that not even happen, you have steady yields today. So there's two parts. It doesn't cut and you have continuing yields, and if it does cut, the value of those bonds are going to be higher in the future. So it definitely would be a tailwind for a 30/70 portfolio.
Okay, I've got a buzzy news headline that I can summarize that with. Bonds are back, baby.
Yep.
They're more a consideration than they have been in a long time. Something to consider, again, when you're thinking about the diversification through something like a 30/70 portfolio. That is all the time we have for the Q&A. Appreciate you both fielding some fantastic questions from the guests. I feel like you have to wear 5 different hats there in that Q&A. Your economist hat, your market forecaster hat, all these kinds of things. But fantastic job, Surenanthan. We appreciate you. And to our audience, of course, thank you for those great questions, and thanks for tuning in as always. Make sure that you check out next week's episode because we have a fantastic one lined up. This is one of my faves, Nick Majuli from the blog of Dollars and Data. He's written a new book called The Wealth Ladder, and in The Wealth Ladder, he's going to share some of the top takeaways to help you move up into that 7-figure net worth conversation. Some of the things that you can do, some of the habits you can adopt to help get you there. Really interesting conversation. Make sure you tune into that. We appreciate you joining us for this episode. That's all the time we have, though. From everyone at Inside Investing, thanks for tuning in. We'll see you next time.
Have more questions? Check out the links to the right and in the description below.